believer in being able to predict the market. I try to learn from it. Rather, I try to learn from what is happening in the market and how we can um, protect ourselves better. I think my first um, you know priority always is to protect investors. Then comes this um, live session is first of all we look at what is happening in the macroeconomic space, what the indicators are telling us, and we will also look at some of the recent geopolitical events that have taken place and how it can affect the markets. One of the things that I tend to take into view is that I'm not a big believer in being able to predict the market. I try to learn from it. Rather, I try to learn from what is happening in the market and how we can um, protect ourselves better. I think my first um, priority always is to protect investors. Then comes obviously generating returns. So as I say, don't make a loss. Then comes the opportunity to kind of generate any returns as such. So we'll look at that, and we will look at the kind of stresses that exist in various sectors, right? Not just looking at the U.S. economy alone, but very broadly, the various stress factors that are there across the sectors and what we are doing with our portfolio. Obviously, this is not financial advice. I'm not here to give you any sort of financial advice or to tell you what to do. We are only going to give you an update of what we are doing. And you're free to follow us, or you're free to do what you want to do. But we'll talk through some of the changes that we see, what specific impacts that I think we need to kind of look at. Right, one of the biggest risks today is not missing the rally. Right, as many of us keep thinking AI and there is this and that and whatever, and there's so many narratives that are there. So I think the biggest risk is not missing the rally. It's being left holding the bag when everybody else is gone. Right? It's like a musical chair currently. Right? A lot of tech stocks are overvalued. I think we've been talking about it for quite some time, but there are still many undervalued tech stocks as well, right? Which is exactly what we will be uncovering as we go along. So one of the things that we have to remember is passive investing has its own risks, which we may not be aware of. And most passive investing is into market cap weighted index and index funds as such. And thereby what we are doing is we're fueling the largest of the large companies. So if you look at the major indices and in fact the most popular index funds, it's basically a mix of the largest companies. So if you take the S&P, it's market cap weighted, and you find that there is basically the largest tech companies in MAX, which have more than 35% weightage on the S&P. We've talked about this a few times in the past, and what as an investing as a whole. Now, as an active manager here at Helix, our purpose has been observing taking taking an active role in managing the risks. And as I mentioned up front, our goal is first of all investor protection, protect from any losses. So our drawdowns are typically very, very low in comparison to various other hedge funds. So we tend to keep that sort of an approach, and then that obviously gives us the opportunity to take upside risks. So our strategy is what we call as a barbell. We take risks on either side, basically like the weightlifting barbell, right? So we take risks on either side, and the middle is basically interconnected core, but very very thin level of risk that we take in the core, essentially the mid level risk as such. So so we look at these factors. First is the sort of macroeconomics, and uh, when we talk macroeconomics, I think the first thing that comes to mind is uh, believable. Is the data believable? Is it stacking up? So one of the big challenges that we have with US data currently is it isn't stacking up. So established macroeconomic models can be used, and we are unable to kind of explain what is happening here. That's the uh, and it's not even a case of, I can say, data isn't right, or maybe it's delayed, or etc. etc. What uh, is what we can see. Uh, there is GDP growth while manufacturing declining uh, consistently for the entire year. Uh, the unemployment numbers are not favorable, and the Fed wants to cut interest rates going forward. Is this all sticking together? I can't even stick this with obviously with duct tape and whatever. Right? That's the reality of this. So what we did was go investigate further into this, see what is happening on the consumer side. So, is the consumer spending? And if they are spending, is that, you know, I think some circles try to call this as K-shaped economy. So there is one side basically there is growth, and the other side there is um, growth in the higher income thresholds, and then you have basically the sort of lower income thresholds are declining. Is that what is happening? Uh, that's not really that's not really true as well, right? One of the um, one of the issues that we see out here is that uh, consumer spending even in the higher income brackets is actually coming as being fueled by debt, right? So, so what this means is that the overall indebtedness is going on the higher side, and with that, what is happening is while some parts of the economy some part of the population is still able to spend, let's say the top 10% in terms of income thresholds, they are still able to spend, while a large majority uh, are heavily indebted, and on top of it, they're unable to spend, right? So that then brings us to the other question: uh, where are the job losses, right? And where is the actual hit from the tariff, etc. So so while one side um, is that basically the narrative is the tariff is a tax on China, on various other countries, etc. etc. It is basically the American consumer that is being taxed, right? So it's basically an additional expense for the American consumer. Whether uh, whether the company in question is actually passing it on as a price increase or not, that's a different story. But we are seeing these impacts all through, and basically the stress is showing on the balance sheets as such. So uh, manufacturing declining, indebtedness increasing, and on top of it, basically the impact of the tariff. Now, most recent, geopolitical update is basically the sort of developments in Venezuela, and there has been some movement in the market. Some of the oil stocks, as well as the oil feed equipment company, Halliburton, reported basically their prices have been jumping up. But some things to consider is essentially uh, one of the most important factors to look at is that country's oil infrastructure is at peak, so it needs significant investment. This is not going to be a case like, I have a new fuel pump called Venezuela, and I can go fill up my car in Venezuela and I can drive down. No, you will not be able to. And it's going to take generations by when you will be able to get there. So it, first of all, uh, that's one of the most important factors. Secondly, to look at um, the quality and the type of the oil that you get from Venezuela. We all know for centuries, at least we know that the oil that comes out from there uh, requires a completely different, refining machinery, because it is heavy, or is it, maybe they call it sludge and metals, etc. So a lot of the investments in refining in the US was built around how to process this kind of heavy crude that comes in. So essentially, what the US used to do was to export its own crude uh, for, I can say, maybe simpler refineries in Asia to go and pick it up and basically run it. While they used to have the capacity to, again, that capacity, how much of that still exists, we don't know, right? So, am I going to jump up with joy saying, we've got new oil coming in from Venezuela? Uh, Economics 101 would teach us that when there is more supply, prices will go down. So, I'm not expecting oil prices to go up. So as a result, I'm not expecting oil stocks to stay, high up. Uh, First of all, if there is oversupply, there's basically a price pressure, and that supply isn't going to be available immediately. And even when that is available, there is going to be, it's basically poorer quality. Uh, so it needs heavy investment in refining as well. So that's for the folks uh, that are kind of rejoicing, with respect to Venezuela. Uh, I don't support in any way the sort of you know things that have happened over there in Venezuela. Nor do I support with any other country going through anything of this sort. Right? We thought we have come through that sort of a phase, and after the World War, we had pretty much of what we call the United Nations of America. So the United Nations, but they always sided with America, so I used to call them the United Nations of America. So we had that, and we had some sort of a rules based system. Now that seems to have gone, but uh, let's let's then kind of dial back and see what is happening in various sectors, and of course, uh, also to look at the transmission of risks from the U.S. economy into other markets as well. Now, all along, uh, we used to basically take the view that uh, many of the other global markets, um, I can say, they kind of mimicked what happened in the US. Now, for the last, I would say maybe around 18 months or even more, we've seen a clear divergence between what the US markets did and what happens in UK, EU, and in Asia. So I'm talking about, I think the first part to actually look at is interest rates. There is a divergence in view between the Fed and all the other central banks. So that divergence creates a couple of things. One is there is a there is a policy related flow that happens, and then the other side is this continuous switch between like risk on, risk off, risk on, risk off, sort of a situation uh, that we tend to have, right? So that is uh, that is the kind of environment in which we sort of operate currently, right? So uh, looking at that, and then also then uh, looking into the sort of infrastructure related constraint. Now we kind of cover the macroeconomic view and where the energy is coming from. So let's say oil continues to power a vast majority of our energy needs, while renewables continues to pick up, etc. Uh, there is a monster in the room called AI, and that monster eats power like anything. Now, uh, with that, um, I think what AI could become uh, really, really large, we need three things. One is we need a semiconductor, call it processing units, there's data center, whatever you want to call it. I can just call it semiconductor. Secondly, you need the network capacity. And thirdly, you need power. And most important, power. Semiconductor, you're trying to do more and more with less and less. And that is how the industry has been progressing. So we take um, a view of what is happening in the semiconductor industry. In the past, we've covered NVIDIA, we've covered Intel, we've covered advanced materials, AMD. Right, we talked about these last year. We took positions on obviously on these stocks. So let's basically take that slightly to the side. We then look at the uh, telecom capacity, right? Boring business, month on month. You kind of pay a bill, etc., etc. It's pretty much a utility sort of model. I'm looking into Verizon. Um, I'm looking into few other telecom players. So how are they upgrading capacity? So even if we hit uh, max capacity with respect to AI, is there expansion space that is possible? What are the various other methods through which we access these AI systems? So where are the blocks that are available? Where are the chunks of bandwidth that are which are available? And then where we see the constraints, who is investing? So I'd like to further research that. That is something that me and my team uh, have been working on, for quite some time. So that is something that we are actively looking into. The third is power. So we've always held a very um, very strong interest in renewables. So we continue to hold interest in renewables. So firms like Next Era Energy, lots of interest in terms of looking into these. But at the same time, we also look at um, you know the uh, uh, the oil and gas uh, related sector, because obviously there is usage over there, and we want to kind of make a good sort of benefit with respect to that. Right. Now, what I'm going to do for the next few minutes is basically to look at some of the changes that we're making to our portfolio. And as I said, our goal has been essentially to maintain, first of all, an anchor, sort of the core, and then we have some core which kind of fits in closer to that barbell, basically sits close to that barbell. Uh, and then we use a satellite that kind of stretches that uh, you know barbell, and then on the other end of the barbell is basically the sharp hook. So that's four parts uh, to our portfolio. So some of the safe bets anchors that we kind of take are companies like Procter and Gamble, Coca-Cola, uh, you know, Johnson and Johnson, Bristol Myers, Mastercard, right? TJX. We've got Abbott Laboratories, Deere and Company, right? All these are part of, I can say, good quality uh, anchors that we've held on to. We're making some changes in terms of weightage, essentially. And then, uh, if you look at some of the other firms that we've also considered, we typically tend to look for a combination of free cash flow and ROIC, both of which have to be growing consistently to be included into the core and the soft core. So that is how we typically kind of consider. And then we also look into the sort of the risks to the business model, and then we take a sort of uh, measured risk with respect to this. So, given that the macroeconomic situation seems to be that a vast majority of the population tends to go towards, I can say, higher indebtedness, and at the same time, uh, the spending is likely to shift. So, uh, what we typically kind of look at is, in that sort of a situation, people are still going to be paying their rent, their mortgage, whatever. They're still going to be paying their utility bills. They will probably shop um, discount retail. So I'm looking at Dollar General. So taking that, so that is something that, that we kind of looked at. Um, one of the firms that's always of interest is Clorox. And again, the reason why I look at Clorox is, yeah, they've had some acts of stupidity, and I would say it was acts of massive stupidity. So that gives us a fair valuation on Clorox. So I'm taking that one. Uh, we also look at Keep Corp as another one for the long book. So essentially, subcore that we're looking at Keep Corp. So looking into FCX, Freeport Macquarie, right? So that's basically copper as a utility, right? So it's good to into that one. Uh, and I think in fact, some of the changes that they're making from the shop book, right? NVIDIA continues to be a shock. Um, there's a subprime lender, essentially, Carvana. They've taken that one as in the short. Netflix, again, um, kind of, I could say, momentum reversal, basically. But it's kind of consumer discretionary. The reason why I look at that is people likely to say, do I still want to keep that subscription right now? And when things are in stress. So I'm looking into the Netflix becoming part of the shopbook lift. Like to take that as part of the shopbook as well. And Google, in comparison to Meta, in comparison to various other companies, Google is an interesting firm to look into, right? So in the AI game, uh, despite what everybody wants to think about, Google is like very well positioned. So I'm researching Google further. So my team is looking into Google and whether we want to consider that. Tesla is on our short book. Uh, it's I don't say it's a bad company. It's just that it is highly overvalued. Um, so so we're taking a shot, basically a structural shot, I can say. It's not a positional sort of a game. We want it to come to I can say a reasonable valuation where we can enter long, right? So that's the reason why we're taking a shot on that. Um, Other ones, yeah, those are pretty much, I would say, the major uh, sort of changes, etc. That we are making. Yeah, CrowdStrike. Yeah, we're taking a shot on that. It's just frothy valuation. Um, we've 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 been on Palantir for quite some time, and one of the reasons why we've kind of kicked that out is there are better um, options at the moment. We're looking into a few other different stocks uh, for the next few weeks. And with the valuation that Palantir has got, we would like it to moderate whether we can enter again, right? So that's on our watch list currently. Right. Those are all the changes for January, and Happy New Year, everybody. If there are any questions, feel free to leave that on the chat, and happy to answer that. Thank you.